I think we've been talking a lot about tech lately. I mean, it's just the conversation you can't get away from. Yeah. And by that, I mean, sort of the hyperscalers are mostly in a different sector, to be honest. But the, sort of semis and the momentum trade, I think, is what we've been largely talking about. And what our work is showing on the semis is that you've hit average valuation levels. If you look at sort of a 5 or 35-year average, we had been hearing a lot of clients saying they thought the momentum wine was late innings, close to done. It's gone on a little bit longer, frankly, than I would have thought. But I would say that's really the genesis of a lot of the conversations of late.
Amy, for your clients, it's a big week for earnings, a big tech week for earnings. How are your clients in the futures and options? Are they leaning into these earnings? Or are they saying, like as Lori said, maybe the momentum thing is kind of coming to an end?
It's so interesting because ahead of this week, big four reporting, huge concentration. Tom's favorite word, skew, it's pretty flat, meaning people are not really deciding to hedge in front of any of these stocks. It's actually fairly sanguine. Look, part of that is we already had a big move in sympathy with Alphabet last week, so some of that's taken it off the table. But to give you an example, Meta, its implied move on earnings day is about 7%. This thing moves plus or minus 10% the last 4 quarters. So the fact that it's an inexpensive move is pretty shocking.
The magic of you two is your worker bees. I mean, you're out there hugely seeing clients. Do clients have a bet, Lori, on the market right now? Are they placing a bet out into 2027?
So, what's really interesting, Tom, and this has gone back a couple of months now, is, I go into the meeting and I have my price target and the methodology and the 5 models and yada, yada, yada. And people do want to talk about the valuation and earnings model because that's fairly unique in our process. But by and large, Tom, people don't want to talk about market direction. They want to talk about, let's look at all the sectors. Where's their opportunity? There's been this view, I would say, the last couple months. I've had plenty of AI, I've had plenty of tech, I've had plenty of semis. What else should I be looking at? And frankly, a lot of the choices haven't been that interesting to people, so you get kind of stuck in those conversations.
So Amy, over in your world, and let's say it's more alternative, more hedge funds, more leverage bets using mathematics, do they have the same feeling of let's go?
Yes and no. There's a little bit of nervousness. For instance, last week what we talked about is this whole levered ETF sphere. There's a lot of, what tail will wag the dog because we've had, my favorite term, the paddling duck on the surface, but you've had these huge multi-standard deviation drawdowns in momentum factor. You have a lot of leverage piled onto these ETFs that are accumulating. And then if you get a burst of correlation, what does that mean to the markets? A little bit of nervousness. But when you look at the hyperscalers specifically, option sentiment's pretty sanguine.
Lori, these earnings we've been having over the last several quarters, including this quarter, have been just extraordinary.
Yeah.
I mean, it's almost August here. I think I need to start thinking about 2027. Are comps going to be like really brutally tough?
Well, I think in terms of, kind of 2Q versus 2Q, there's going to be some wonkiness. But I think the reality is that companies, have done a beautiful job of managing through all the challenges we've, as a society have thrown at them so far. That doesn't always last. And so one thing we've been highlighting to people is that sort of a risk we see in the coming months is at some point you may need to pull down 2027 earnings forecasts. And that's not so much about the comps, but it is the idea that if you look at the Iran war, for example, the buffers, the inventories, the hedges, those things that are kind of getting you through the next couple quarters, well, you're going to have to reset those. You're going to have to replenish those. We even heard last week one rail talking about how plastics inventories were starting to be rebuilt. Those are going to be done at higher prices. So I think that, kind of the idea of what you were able to manage through this year, if you have lingering impact next year, might just not be so easy.
Across America this morning and in Canada as well, Amy with Silverman, Lori Calvasina together from RBC Capital Markets. Paul Sweeney with the ladies who they lunch, they dinner, they're in airplane terminals a lot.
Yep, exactly right. I remember those days. Amy, are you surprised that we're not seeing more hedging in your world? I would think on margin, we hear about the wall of worry. I would think we have had a pretty good year here. Earnings can't get any better than this, can they really? Are you surprised maybe you're not seeing more hedging at all in your world?
I try to talk my book and talk about how hedging is still relatively inexpensive. I think there's this element here of people still remember back to April 2nd. They still remember back to Liberation Day. They know there's this kind of cohort of retail who likes to step in. They like to buy the dip. It's changed a lot of the relationships in our market. This idea of spot goes up and volatility goes up, that's a little mind-blowing for someone like me who's been in the market when that's not true. But there is that hesitancy. I do think as we kind of cross out of earnings, maybe into midterms, you start getting more overall correlation and pick up risk, maybe some more geopolitics that does start to change.
So I don't know. I mean, I'm thinking about this, Lori. Are there sectors here? I got to get away from the AI trade at some point. Where do I go? I mean, do I buy financials, healthcare?
Well, look, it increasingly, right, AI is penetrating everything.
That's true.
Back at our energy conference in June, I went to one day of it and heard a lot about how the energy companies are powering data centers. I mean, but look, I do think that if you look outside of tech, we've been overweight financials for quite some time. We've been sticking with that, reiterating that. The valuations still look reasonable. I wouldn't say they're cheap. Earnings revisions are very strong. And look, last week, I was sort of responsible on the team for reading the financials companies. And I was just really struck by all the innovation that's coming out of certain companies, not necessarily just the big banks, but seeing companies talk about things like prediction markets and how that appeals to their client bases. Seeing the retail brokerages talk about this new retail investor and how we've really changed who's participating in the market. There's a lot of really interesting stuff going on in financials besides AI right now.
Amy, the people that you talk to, like the difference here is they all drive Maseratis, and fancy cars like that. Lori's talking to people. They got, they got the Range Rover. There's a difference here in terms of cars. The fancy people you talk to, like Coop, who's on Your Friends and Neighbors on TV, are they in the market now, or are they cruising through the summer? What's the intensity right now?
I would say, prior to maybe 2 weeks ago, there was kind of a positioning clean out, and a lot of people felt like that shakeout was good coming into earnings because it gave people a clean slate. Now I would say when you look at the flows, people are fairly involved. And I guess one warning signal for me is that both credit, both fixed income, both rates, they haven't been flagging the same awesomeness that you've seen in equity. You really see that in CDS spreads against equity puts
Exactly.
And that always makes me nervous as an ex-fixed income person. I don't know, Tom, you decide who's smarter, but the signals in the market, they're currently not telling you the same things, but people are fairly all in on equity.
No, I totally take that. So there's leverage pulled back because they're starting to see whispers in the fixed income market?
Yeah, I mean, I would say they're not even whispers. They've been fairly loud for quite a long time. People in fixed income are not happy about the debt issuance. You see that in the widening CDS spreads. You see that in the change in rates volatility. And obviously Wednesday, we got a big one in terms of what Warsh will say, even if nothing occurs. So I think that might reprice a few things.
Tom, your SpaceX has got a 110 bid pre-market, Tom. So I know you're not happy about that. I think you bought that a little bit higher.
Lori saved me. She called me up. She said, don't take the 8,000 shares.
Lori, what's the market? Just generally speaking, when you see a big monster deal like SpaceX come out, trade up initially, but boy, it's been really heavy since then. I mean, we got Anthropic presumably going to come public in the fall. As a strategist, what's that tell you about just the new issue market and what that tells you about that?
So look, I would say for me, I sort of relate this question to market froth. And when I think about, and unfortunately I just can't really get into the IPO dynamics, but if you go and look at like a lot of different gauges, we see some evidence that the retail investor has looked a little bit frothy. If you look at the conference board data point on stock market optimism, but if you look at things like AAII, if you look at things like CFTC, futures positioning, we're not seeing those same signals. So I understand the concerns people have, but I'm not seeing reason to panic across a wide variety of indicators.
Lori Calvasina and Amy Silverman with us, a special treat in the studio together. I mean, they have to. I think President Mr. Carney of Ottawa is involved as well. They can't be in the same room together.
This is a treat right here.
Pretty cool treat.
Amy, we've got a lot of people that have been telling me for a long time that election year's dicey. You got to be careful here. Are you seeing people maybe, do you think you're going to see on your desk people trying to buy some hedging going into these elections? Is that typically what you see or not so much?
I would say yes this year. I'll tell you, Lori and I have been doing quite a few marketing sessions together. And one thing that has been coming up in terms of sentiment change is essentially this worry that midterms isn't going to be about gas prices. It's not necessarily going to be about inflation. It's going to be about anti-AI. I remember in one meeting we step in and the first thing the client asks is, what do you think of this data center moratorium? What does that mean? And so the point I'm trying to make is, look, what if anti-AI sentiment becomes more than just an election story? It becomes a market story. That's something to me that can really reflate correlation in the market because it touches all aspects of the markets. The surge protector plugged into itself, right? Like we know a lot of these things have tentacles. And that's something that we're watching quite closely.
So talk to Lori now and our audience worldwide, Amy with Silverman. What do the left and right tails tell you right now that redound over to Lori's world of long-term investment?
So one of my favorite Lori charts in the whole world is her 4 tiers of fear. And I can tell you that the left tail
That's just to have the children to go to bed.
Yeah, well, that too. But we're not pricing in tiers of fear on that left tail, and we're still pricing in kind of exuberance on the right tail, in particular when you look at some of, not semi specifically, but when you look at the hyperscalers, they haven't changed that much. And to me, it's interesting when you see that start to flag, then I think that sentiment changes.
So, Lori, as Barry Eichengreen would call it, the financialization of the system, the Amy Will Silverman slice and dice tranches and all that. The foundation is still America's nominal GDP over to inflation and that. When you talk to the derivative crews, what do you tell them about the foundation of our economy?
So we do kind of go to this tiers of fear page, and it's basically tier 1 is 5 to 10% garden variety pullback, tier 2 growth scare, tier 3 recession, interest rate shock, tier 4 we don't talk about those, we all know what those are. And we saw this back in March. We did a round of marketing together, and we kept putting that table in front of people, and I said, look, if you don't think recession is on the table, you're sticking to tier 1. If you think it's a recession near miss, this was when the Iran war was still escalating and markets were still falling. I was like, look, if you think it's a growth scare and we're going to fear recession but not actually have one, you go to tier 2. If you think it's actually a recession, you go to tier 3. And the hedge funds kept pointing to tier 2 and saying, I think at worst it's going to get to this, but we're probably in tier 1. And that was probably the most valuable thing we learned in March, was that people were nervous. They were watching the market fall, but the fast money was not looking to bake in recession. And that helped us, sort of really understand when the pivot happened that it was really the pivot.
I don't know, either of you two or both, are hedge funds net long today, or are they net short, do you think?
So I would say there was this clean out prior, maybe like a week and a half, 2 weeks ago. And then I think in terms of flows, most folks have gotten back in. And there's a little bit of tentativeness right now because we have a big concentration week. But there was sort of a clean out, I would say, a week and a half ago where people had taken a lot of risk off the books.
Really?
Yeah.
I think in my world, right, the long only space, you're always invested, right? It's a question of whether you're up quality or down quality. I think it's very funny because I do think, as I've been out on the road talking to the long onlys, everybody's kind of talking their book. So the people who need rotation to work are in the pro-rotation argument. And the growth funds who are really more all in on the AI trade, are more sort of talking about that's going to bottom out pretty soon, sound a little bit more like the hedge funds. But I do think, kind of going back to the midterm conversation earlier, it's just coming up in more and more meetings, and I'm not getting a sense of what trades people want to do yet, but they are starting to want to talk about it after a year of not wanting to talk about stuff like that.